Welcome to the Mistake Free Real Estate Podcast. I am your host, Marck, and I'm really excited today to be joined by the leader of the Tempo Growth Fund, Big Mike Zlotnik. Mike, welcome to the show.
Thanks, Mark. Appreciate the opportunity to be on your show.
Big Mike, the Big Russian, is a great friend of mine. We share two masterminds together, the Collective Genius, as well as the Freedom Founders Community. And so Mike and I get to break bread probably 5 or 6 times a year. So we've really developed a good friendship. Mike, for those that don't know you, tell us a little bit about your background and where you come from, how you came to America.
Thanks, Mark. So I come from Russia with love. Well, it's not exactly that, but I'm originally from the former Soviet Union, actually Republic of Moldova. I left it. It was still Soviet Union in '89. Still Gorbachev was the, remember Mikhail Gorbachev was the head of the country. And I came to the States as a political refugee from the Soviet Union. I'm a US citizen, I'm a US patriot. So I've lived here ever since, and this is my country. I live in Brooklyn, New York, married 21 years. You just said you celebrated your 20th, or coming up, and I'm 21 years and 4 kids and a cat. So we live in Brooklyn, New York, and just a couple of words about me. I spent almost 15 years in software, from rank and file all the way to senior vice president positions. Had a success career in IT, and then went with my passion, real estate, similar to your story. Been investing in real estate since 2000. In 2009, I went full-time because it's something that I love to do, something that makes me money, and something I'm good at. So when you find something like that, you don't want to do anything else. That's it.
No, absolutely. And Mike, how did you make that transition? How does one become a fund manager? It seems like such a leap to suddenly do a big fundraise. Did you have one whale that kind of helped you along the way, or did you have a lot of people that were wanting you to go down this road? Tell me about that process that you went from corporate executive to kind of real estate guy to now having a growth fund.
So the transition was sort of by choice. In 2009, I was burned out in corporate world. Again, having a successful career doesn't mean you're happy. You get sick and tired, and at some point, you appreciate the benefits of investing in real estate. So I made a conscious move. Friend of mine, lifelong friend, started original Tempo funding. He still stayed in IT, and he still is in the IT, running a major operation in a technology company. But he started original Tempo funding. He said, I started, but I don't want to run it. I just want to stay passive. And he asked me if I can basically jump in and take the ship from ground zero. So 2009, I jumped full time. We were focused originally on short-term flip funding, called transactional funding, flash funding. As you remember, there were a lot of short sales. And folks needed capital. They needed to buy a property for 300 grand and flip it for 350. So we provided a number of that funding. It's kind of funny. Jason Medley had our visionary. Our visionary was also transactional funding. They were kind of number 1, and we were number 2 during that period of time. And Jason kind of left the field and went into started the Collective Genius. And he sent us some business, and we basically continued to do transactional funding, but we quickly evolved into a lot of the extended funding and fix and flip funding. So we basically became a funder on light fix and flip projects. Some short sales had a 90-day no flip restriction. So it basically became extended funding, and we kept raising capital. When you do flash funding, you need less capital. Obviously, the money comes back in 2-3 days. As you start doing 90-day, 120-day funding, we started to raise capital, and the returns were pretty good.
And what kind of projects are you working on currently in this marketplace?
Yeah, let me kind of run through just kind of the evolution. So we continue to do hard money lending, bridge funding. We continue to do that to the day, but we started to invest in commercial projects in 2007. So we launched Tempo Opportunity, 2017. So we launched Tempo Opportunity Fund, our first growth and income fund, and then Tempo Growth Fund, as you mentioned, it's our latest and greatest product. We just launched it in at the beginning of 2020 because the opportunities we started to see were very complementary to our lending. So we've built relationships with a great group of guys like you, movers and shakers, the operators, the CG guys, and the best of the best in real estate. Some of them were specialists in residential real estate, and some were in self-storage or multifamily and so on. So we evolved, we started seeing these projects, and I've been investing in real estate for years, and kind of the revelation was, why are we not investing in these great value-add projects? Why are we not investing in some of these commercial deals? So over time, we started to invest, and the strategy has been evolving over time. I'm now jumping all the way to 2020. We are in Q4 post-COVID world. So we've done many deals across many sectors. Again, multifamily, self-storage, retail, office, distressed debt, so on. But today, the hot subject is conversion of hotels to affordable housing. So I brushed aside all other interesting opportunities, but this is kind of what we are focused on right now. We literally, we funded one project 2 years ago, and it's a huge success. It's literally selling well above the projected price. That was a pre-COVID project. Now, post-COVID, we invested one in June. We invested one in September. We have one more coming up literally probably around December 1st. And then we're going to do another one late December. And that is sort of a conveyor belt. These conversions of dysfunctional hotels seems to be the area of opportunity. So example, Residence Inn by Marriott conversion in Winston-Salem, North Carolina to affordable housing. You're not picking up downtown hotels. You're picking up a hotel that's sort of in the residential neighborhood, but it's not functioning today. And it's not clear when it will ever function well. So, but these hotels, they look like apartments. They have kitchenettes installed, and the conversion is fairly light. Plus, they have hotel amenities for the community. So that's what we're focused in the short run today. We're obviously very opportunistic. COVID has created some opportunities. Some people are doing well, and some people are distressed. We're looking how to invest in the post-COVID world. This is one sector that seems to be pretty interesting.
Mike, what do you see in the commercial world happening? I mean, obviously, COVID has taught us that we can do a lot of our work from home. We can do a lot of our work remotely. How do you see it playing out with, potential conversions of office buildings, office complexes, vacant office? That's going to be a tougher conversion to residential. What do you see from people and practitioners you're talking to, as to this new commercial? Is it going to be a distressed opportunity in 2021 and beyond?
Yeah, it's a great subject. Thank you, Mark. We do have another project we're investing in right now in Kansas City. Sorry, St. Louis. You're in Kansas City, in St. Louis. Conversion of a office building right next to the ballpark, to the Busch Stadium, to multifamily. That is not affordable housing. I mean, that's kind of a high end. It's literally right next to the stadium. You can actually see the game from the rooftop and number of apartments in this building. So this type of projects will take place as people need to live somewhere, and as an office building, it just doesn't work. It's got a great location. It's next to a stadium. People would love to see the game from their apartments. So it's a redevelopment trend. These do take place. So it's an example of exactly what you said. But in general, it will really depend on what kind of market, submarket. Take New York City. I'm in New York City. The city is going to be in deep distress for quite a while related to COVID, for the reasons that people are telecommuting. They're not going into Manhattan. So the supporting retail real estate is in dire straits. They cannot function. Many supporting restaurants and small businesses are just closed because the office workers are just not coming into Manhattan. On top of that, you got no tourism. So big metropolitan cities that also rely on tourism are going to suffer for a substantial amount of time until we're in a completely post-COVID world. So downtown hotels are suffering, midtown hotels are suffering, no tourism, no Broadway, no museums. So some parts of the real estate will be in this repositioning for a long time. Can they be converted to apartments? New York City is a major shortage of affordable housing. That has always been the case. But do you take a substantial hotel, midtown or downtown Manhattan, and try to redevelop it? That's a big question. Can you do it in a way that numbers make sense? And it's not clear. The projects I mentioned, Winston-Salem, we have another one in South Bend, Indiana. Those are very straightforward, easy conversions. The numbers work because they're being acquired as a foreclosed property or significantly distressed property. Yes, it comes down to the asset has to be in severe distress so that the seller is motivated, whether it's a bank that foreclosed on a property or a short sale, commercial short sale. But if the price is right, the numbers work, you could do a redevelopment project. Obviously, adding any kind of city credits, any kind of tax abatements, or any of that stuff to help the project, it will make the numbers look better. So where are we going? I would say that we'll still be in this COVID-like world for a substantial amount of time. I mean, we are still late 2020, even if after vaccine is developed, and now even after it's distributed, it'll probably take the entire next year. A number of commercial office projects just will not make any sense to invest in unless there's a good redevelopment plan. Or you're getting the price so low then you can actually withstand holding on until things come back to normal, right? So it's either patience, buy cheap enough, have enough cash to pay the taxes to keep the thing afloat until things come back to normal, or you got to have a redevelopment plan. So that's what happens with the distressed parts of the real estate. And then there are assets that are performing just fine. I mean, you operate in the turnkey range. That asset class is doing phenomenally well. We've been investing in that class into portfolios of these properties because affordable range cash flows are good. If there's a good management, the stuff is stable and it works. On the commercial front, self-storage still continues to be a pretty good sector, recession-proof. So we see some opportunities there. Multifamily value adds, sort of a classic. You can pick up an asset that's in an A area, but kind of it's been aged, right? Curb appeal is not the same. So we have a project like this in Indianapolis. We have two of them actually. So substantial upside by virtue of renovation of apartment communities. Yes, there's a post-COVID, concern, but if these are not elevated buildings, if they're 2 or 3 story buildings and they're spread wide enough, it feels like you're living in your own space. So these type of communities are going to define. Big elevated buildings, big concern for sure. So okay, let me
Tempo Growth Fund, is that something that anyone can be a part of? How do they, is it accredited investors only? How do they reach out and get in touch with you?
Sure. So we invest through our funds. We invest personally, obviously, in our funds are the vehicles how investors participate. So Tempo Growth Fund is a fund. We only take accredited investors. And people could reach out. TempoGrowthFund.com is one website. I can remember BigMikeFund.com. And if you misspell it, BigMikeFund.com, I promise it's not a kinky site. So fairly easy to remember. But our family of funds, you can go to BigMikeFund.com and you'll see Tempo Opportunity and Tempo Growth. So these
one of the benefits I enjoyed when I invested in your fund recently was the prospect of getting some accelerated depreciation. Can you talk a little bit about the benefits of that when you're trying to offset some high wage earnings?
Yeah, Mark, I appreciate that. I wouldn't I would maintain your privacy. You mentioned you invested with us, so I greatly appreciate that. It's a little bit of the soft endorsement without endorsement. So yes, we greatly appreciate the investment, and we have many great guys like you. And the funds pass through very substantial depreciation benefits. So it is one of the key benefits. If you're a real estate professional like you could use the depreciation to offset your current income. It's a massive benefit to basically reduce your tax liabilities today. The second benefit is if you have capital gains, you can sell an appreciated asset and in the same year invest in for example, Tempo Growth Fund. You can use depreciation benefits as a passive loss to offset the passive income. So there are two kind of interesting benefits. Did I answer your question?
It did. So look, hey, I know we're pushed for time, and you've got a pending appointment. But is there anything else that we've missed? Tell me a little bit about what's the most fun thing you do as a fund manager? Why is it that you still have passion for what you do?
So the short answer is I enjoy doing deals. I really enjoy having conversations with guys like you. Like we talked about that historic building redevelopment. We do this day in and day out, literally making deals with movers and shakers. Not every day, but let's just call it every week, every month. So having deal conversations, financial engineering a deal, putting together the structure, looking if it's a good deal or not a good deal, um, picking the best guys we can work with. Again, part of our investing, we have a few deals we're working on to invest from our funds. Give you some examples. New CG guys, they do discount lots. They buy land for 30 grand a piece. They sell at 18,000 or sell at financing. So we're looking to give them expansion capital. As I mentioned, hotel redevelopments were the opportunities. Working with other CG guys who are looking to build in other markets, some affordable housing, just like we talked about on your podcast. The entry level deals make ton of sense. On top of that, the deals come in and we just look at them, and sometimes you got to bounce a deal. It is not the most fun part of the job, but it is part of the job. In fact, you got to bounce more deals than you invest in. So that's sort of what I really enjoy, and this is one of the biggest value we add to our investors. They invest in a fund for a couple of reasons. Number one, it's our experience, track record. So we give them the best access point. They would like to invest money passively, get great return, and not worry about doing this. What is this? This is what I do. I look at deals that underwrite, find best of the best. I love doing it. Investors are passive, they're benefiting. And the second key benefit is diversification. We spread the risk around. So one thing that COVID taught us is that if you are concentrated in a sector that's going to get beaten up, like hospitality, you could lose your shirt. So the point is, you can't go wrong by diversifying, and that's what we do on a fund management level. We'll look at every deal. Even the best deal we find, we will never overload our portfolio. We have to diversify among many dimensions, regions of the country, different operators, different asset classes, debt, equity, and so on and so forth. That's sort of how it works.
It's an interesting position to be in because not only are you exercising your creativity, but you also get to work with these amazing people and see how their genius works as well. But the one, uh, I guess recommendation or testimony I'll give to you is that when we were really hard up against it, the creativity that you had in the financing was second to none, and I really appreciated the guidance you gave us through that challenging deal analysis. And your brain just works in a different way than most, and the creativity that you have for putting a deal together is outstanding.
Mark, thank you for the kind word. I appreciate that. I'm a little sad to hear that the deal didn't go, but you don't regret the deal you don't do. So not spending enough time, energy, and some cost and avoiding a mistake, a deal that can actually go really bad, is much more important than getting into the deal and then trying to figure out what went wrong.
Without getting into specifics, about how many deals do you look at that you bounce before actually saying yes to a deal? What's your ratio?
So before I answer the question, let me be very, very specific. We don't look at any cold deals. Every deal that comes across comes on a strong referral from existing relationship. So that's our universe of deals we look at is already much smaller. There can be great deals out there, but if we don't have strong referral, we will not waste our time looking at this. So in general, 1 out of 4 deals gets funded. So for normal people who look at apartment complexes and then they go through, they can look at 1,000 a year and invest in the 2 or 4. Right, that ratio has to be huge if they're doing kind of cold underwriting on volume. For us, unless the deal has already been pre-vetted from a very, very competent sponsor and operator. So let me just give you this general overview, how we work. So it starts with know, like, and trust people. We always start with people. If it comes from a person we don't know, it's a non-starter. we know like a person first, and they're a competent operator, and we know they do deals in multifamily, or they do deals in turnkey properties, or they do deals in self-storage, we already know they won't bring a crappy deal to us. The deal can be enhanced a little bit, but it's a decent starting point. They won't waste their time and our time. So it starts with people. Second is the deals and the capital. So those go together, the second and the third. So as we see a competent operator bringing a deal, that point becomes negotiation. So can we make this deal to be attractive enough to you to go forward and attractive enough to investors? And it's a negotiation on the terms. Does the deal, first of all, make sense? And if the deal makes sense, then the mathematics work out. So what the first thing we compute is what is the target return on a project level, regardless of how much goes to the GP or managing partner or general partner and the LP's investors. If the target level on the deal is 40% per year IRR or something like that, very strong, then you can make it work. There's enough meat on the bone to split. And then we go into a negotiation and decide, do we do, how much debt can we get? Do we need mezz debt? Or do we need preferred equity and common equity? And when we structure this, it works really well. But if the deal makes sense and the capital stack makes sense, then we ultimately make a decision, can we invest bigger dollar amount in this deal? And even if we do, at times, we'll help the deal close and then we'll sell it off to other investors because we don't want to overload our fund into anything. So it's kind of a balancing act, but it always starts with competent people.
And I think that's why you invest in masterminds, because the best way to surround yourself with competent people is by being in the room of high performers. And that's what I've enjoyed, certainly with my interactions with Collective Geniuses. The level of competency in the room is outstanding. I'm sure that again, that's how you can go from looking at 1,000 deals a year, to qualify to your ratio of looking at 20 deals a year to get 4 deals. So,
yeah, exactly. And I mean, this is credit to Jason Medley. We love him, and he's a great guy, and that's why we go in. Same thing for Freedom Fund, is working with very competent, high net worth folks. It's you have finite amount of time. You need to have best relationships. That's the bottom line. If you have too many relationships, it's no good. So picking and choosing your best operator, and we do this every day. We have great communication with you. We have great relationship. We would love to do more business with you. If we find an idiot, they show cracks in the ice, we very quickly, clean that mess, and we move forward to work with the best people. Sort of winning is I think Vince Lombardi said it. Winning is a habit. It's not a one-time thing. It's an all the time thing. You either do it or you don't. You either have the habits of success and you work in that direction, or you have habits of continuous failure. So
yeah, one of my favorite quotes, one of my best friends that's extremely successful and owns multiple businesses, back when I was, still doing the whole real estate game, he said, Mark, while you're busy trying to hit the home run, I'm content to just make singles playing golf every day. Sometimes it's best to just be content to go hit those singles day after day after day. And I think that's what you guys do well, is just always looking for win-win deals. Mike, talking about finite time, we're certainly up against the clock, but I appreciate you coming on the show. It's been a pleasure. And I know our audience will get a lot of value out of what you've said today. Thank you for your time.
Thank you very much, Mark. I appreciate it.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late-night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.